Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. CMQ investors, welcome to the show. It is great to have you here. In this episode, you're going to learn why I am not selling any of my Apple shares, despite the fact that Apple is about 12% of my total portfolio. I share the wisdom from Warren Buffett that ultimately helped me make this decision to stay the course, despite the fact that I do feel uneasy about being so concentrated in one stock. Now, this episode is a continuation of our last episode, so if you've yet to listen to that one, I recommend you do, and that way you'll get the most out of what you'll hear in this episode. I should also mention, if this is your first time listening to the CMQ Investing Podcast, please take a couple of seconds to follow along on Apple Podcasts or Spotify, and that way you'll never miss a new episode. Also, if you want to show your support, please leave a 5-star rating and a written review on Apple Podcasts. That goes a very long way in helping more people discover the content. With that said, let's get to it. Okay, there was a point here about, stay away from Apple because it's almost $3 trillion. So that's fun. That's from Fernando, which I appreciate that comment. I'm not selling Apple, and I'll tell you why. And this comes, guys, this is actually really cool that I have this on deck. I'm proud of myself right now. Warren Buffett, in I believe it was the 1996 letter to Berkshire Hathaway shareholders, he wrote the following. So I want you guys to listen to this as one of the reasons why I don't plan to sell my shares in Apple, just because the market cap is closing in on $3 trillion. Buffett writes the following: "The art of investing in public companies successfully is little different from the art of successfully acquiring subsidiaries. In each case, you simply want to acquire, at a sensible price, a business with excellent economics and able, honest management. Thereafter, you need only monitor whether these qualities are being preserved. When carried out capably, an investment strategy of that type will often result in its practitioner owning a few securities that will come to represent a very large portion of his portfolio. The investor would get a similar result if he followed a policy of purchasing an interest in, say, 20% of the future earnings of a number of outstanding college basketball stars. A handful of these would go on to achieve NBA stardom, and the investor's take from them would soon dominate his royalty stream. To suggest that this investor should sell off portions of his most successful investments simply because they have come to dominate his portfolio is akin to suggesting that the Bulls trade Michael Jordan because he has become so important to the team. Or if I do a 2021 version, it'd be akin to suggesting that the Golden State Warriors trade Steph Curry because he has become so important to the team." So remember, guys, I purchased Apple for the first time in 2015. I believe the last time I've added to the position was in the summer of 2020. It now makes up a very sizable portion of my portfolio, about 12% of the total. And then I'm including here stocks, index funds, and crypto. I'm not including real estate or cash. I'm just saying 12% of my stocks, crypto, or index funds are 12% of that is Apple. So going off what Buffett said there, he said as long as the qualities are being preserved, the qualities being excellent economics and able and honest management. As far as I can tell, and I stay up to date with Apple because I feel like that's my obligation as the owner of a piece of that business, Apple has not lost any of the qualities that I first found attractive. And I believe that, there is plenty of run left. It doesn't mean that every year is going to be a banner year. But I think if I sold, and Fernando, I appreciate this again, but if I sold, I'd also have to find something better to do with the money. And I don't have any better ideas. I don't know. I would have a significant amount of cash that I don't necessarily have any better ideas as to what to do with it. So I'd rather just let the compounding process continue and not interrupt it. And I hope that portion of that letter from I hope that portion of Buffett's 1996 letter is helpful in not only explaining my own decision making, but also, for any of you who are in a similar situation with an individual stock that's, now starting to take up a large percentage of your portfolio. I have a couple more thoughts on this, though. There is a concept from psychology, specifically for behavioral finance, called the Disposition Effect. And that is the tendency for an investor to hold on to losing investments too long and sell winning investments too soon. In the months following the sale of winning investments, these investments often continue to outperform the losing investments still held in that investor's portfolio. Now, why would someone wait too long to sell a loser? Well, it really depends. But a lot of times, people want to, they don't want to acknowledge the fact that they were wrong. That's one reason. You want to believe in your own decision making and your own smarts. And as far as why you might sell something too soon, you could go to prospect theory, which is something that was developed by Daniel Kahneman and Amos Tversky in the late 1970s, I think 1979, that it talks about how the pain of a loss is more impactful than what would be the joy that would come from a similar size gain. So losing $10 hurts a lot more than gaining $10 would feel good. I wrote here, in other words, the pain you experience by losing $100 is greater than the joy you would experience from winning $100. Behavioral finance buffs point to prospect theory when explaining our urge to take some profits. And going back to Buffett, as long as I feel like those qualities of the company are still there, then I would be probably making an irrational choice to sell now just because the market cap or just because, it's had a really great run. So I hope that explains it at least. And it's important for me to share this too. So I, maintain my rational perspective here, because it's very easy to get, it's a little scary to have that sizable amount in terms of percentage amount in one name. I'm not above being a little scared by that. But I wrote that selling shares of Apple now would be because I want to avoid being too concentrated in one position. And while intuitively this makes sense, but as I often say, most of the best investing related decisions are counterintuitive. All right, CMQ investors, that is the show. Thank you so much for listening. Make sure you follow on Apple Podcasts and Spotify. And if you want to support us and support the content and help more people discover it, make sure to leave a 5-star rating and write a written review on Apple Podcasts. It goes a very long way. And as I always say, I really do appreciate it. With that being said, my name is Chris Franco. Thank you for listening. We'll talk soon.